Welcome everybody. My name's Lawrence Underwood. I work for FD Recruit. We've just set up this virtual boardroom webinar, whatever you want to call it, just really to help you guys. It's to support the network, learning new things, meeting a few people, and expanding your network. Really, it's just to support our network. So thank you for your time today. I appreciate it. Just in terms of admin, like I say, throughout the presentation, if you can have yourselves on mute, that would be helpful. It just saves any background noise or anything like that, or any echoes. But have your videos on, that would be nice, just so as we can see you all. And if you struggle to know where that is, it should be on the bottom left, just saying start video, something like that. But in terms of the presentation, it will only be 20-25 minutes. I'll welcome Duncan in a minute, but you'll have the presentation first. I think because of the numbers, there's quite a few people booked onto this presentation. I think it'll be a bit bedlam if we just are, you have your questions throughout. So what we'll do is we'll get on with the presentation, and then if you have any questions, we'll deal with that at the end. But what I would suggest is just email me. There's a little chat thing icon at the bottom. Email me your question that you'd like to ask Duncan, and I will ask it at the end. It just saves not knowing who's asking what and the people talking over each other. Just helps with the admin side of things. So any questions you have at the end that you want answering, just drop it in a note to me in that chat box, and I'll attempt to read as many as I can. Look, if there's none, great. But if there's a lot, we'll try and get through as many questions as we can. The aim of the presentation really is to introduce you to Duncan for one thing, help you with this particular topic, and it may be that all your questions are answered, which is great, but it's a bit of an overview really. I think what tends to happen in these things is it's an overview, but things can go a lot deeper. So if you have any burning questions or you want more detailed answers, just connect with Duncan afterwards, find him on LinkedIn or ask me. Just approach him, and you can take any questions you have directly from him and get in a bit more detail. So this is a bit of an overview. Any questions, type them to me and I'll ask them at the end. Now we've got a bit of a technical issue, which should be okay, but unfortunately Duncan's camera doesn't work. So I will share the screen, he will be talking, but unfortunately you won't be able to see him. So that's the only issue we've got. So bear with us while we go through this, but it shouldn't be much of an issue really. And what I'd just like to say is thank you to everybody for joining. Now, Duncan Walker, who's the partner at BDB Pitmans, he's the one that's doing the presentation. Again, thank you to him for his time doing this presentation. What I'm going to do now is I shall share the screen, which has got the slides on it, which you'll all see, and then I'll pass it over to Duncan. So Duncan, welcome and thank you for your time. Over to you.
Thank you very much, Lawrence. Thanks everybody for attending. And once again, really apologise for the video issue. Some people would say that would be an advantage. There is actually a photo of me on the last page of the presentation, so we'll get to that eventually, I guess. I'm a corporate partner at BDB Pitmans law firm. I'm based in Cambridge. We've got offices in London, Cambridge, Reading, Southampton. What I'm going to cover today is a few updates relating to corporate legal matters. Hopefully they'll be useful and some of them will resonate with you, but as Lawrence says, very happy to take questions at the end. This is a bit of a whistle-stop tour and I will be quite superficial for the sake of speed, but I'm sure you'll be able to spot those things that are of interest to you. So we'll move along straight on to the next slide, if that's okay, Lawrence.
Yeah, thank you.
So I'll just put it out there. I'm going to cover 4 topics pretty briefly, and this is the first one of them, which relates to single director companies. Okay, so it's perfectly permissible in the UK for a company to only have one director. That's well-established law. But there have been a couple of cases in the last few months which have shone a light on some technical issues relating to single director companies, and I'll explain what that is. Most of you probably already know about model articles. So a company can adopt its constitution as it wishes. You can have whatever you like in your articles of association, which is the rules governing how the company is managed. To be helpful, the government have published something called the model articles, and a company can adopt the model articles as they are, or they can adopt the model articles with changes, or they can adopt something completely different. Be aware, though, that it may be that the company actually has adopted model articles or amended model articles, even though it's not obvious. So you might look at the articles and it's just text, but actually what they are is repeating the provisions in the model articles. And I'll explain why that's relevant. There was a company that went into administration, for Fitness Investments Holdings Limited, and there was an argument that some of the things that the sole director had done were invalid because the company hadn't got a quorum at its board meeting because there was only one director. And I won't go into the precise model articles unless you want me to, but what the High Court decided was that the model articles said that, you know, even though it's possible for a company to only have one director, the model articles impose a quorum requirement of 2 directors, which is impossible to fulfill if there's only one director. Therefore, the Directors Act had been invalid. This was dependent on the content of the Articles of Association, but as I said, it was the model articles, and a lot of companies do adopt these provisions in question, probably more companies than not, actually. It is fair to say the decision was a surprise to the legal community. I think the question was well known, but the intention was clear, and everybody had got comfortable that another section of the model articles covered the point, but the judge took a different view. There were very soon afterwards, and I think by coincidence, there was another decision called Reactive Wear Limited, which took the opposite view, and the judge in that took great pains. I guess this was professional courtesy, it might even have been his friend, took great pains to say that he didn't think that the judge in For Fitness was wrong, and that was a different facts, but I'm really not sure they were different. So we actually have 2 conflicting decisions. Neither of them are strictly legally binding because they're High Court rather than Court of Appeal, and neither trumps the other. So we have some legal unclarity at the moment, but our advice to clients is clear. You know, don't take the risk on this. If you've got a company that has only one director, I don't know if many of you involved in companies with only one director, but you probably are, you should have a look at the articles and play it safe, and make a change. And it's quite a quick and easy fix, actually. And we've got some standard language, as I'm sure other law firms have as well, which will put the matter beyond doubt and make sure that a single director company is okay. Another alternative is to appoint another director, but that might just be overdoing it. You will need to be a bit careful in changing the articles or appointing another director, because of course you have the potential problem that current activities by or current decisions by the director are invalid. So you have to take a slightly different route to make sure that your changes in the articles aren't also invalid. But you can get legal advice on that as well. Should you be worried about things that have happened up till now? Well, possibly. We're not saying that clients should go back and try and fix everything that's happened in history, but it could come up. It could come up in due diligence if the company is sold, for example. So if worried, there is a way to deal with that by shareholders' resolution. But I think the main thing is to fix things going forward and at least stop the problem continuing. So that's single director companies. And we can move on to the next one. Thank you. EMI options. I'm guessing that most of you are involved with companies or have been involved with companies that have EMI options, and maybe EMI option holders yourselves. Maybe a quick show of hands of people that, you know, to whom this is currently relevant in their job. Yeah, lots of hands, not surprised. EMI share options, I won't go into what they are, a lot of you will be aware anyway, but they are a highly tax efficient share incentive for employees of small companies, and it's a deliberate effort by the government to encourage incentives and employee share ownership. There is inevitably a detailed regime for compliance and reporting. In the recent change is that in the spring budget, which was trailed by a proposal back last November, the Chancellor announced a bit of deregulation of the EMI options requirements, which is great news for lawyers and tax advisors and accountants who work on these options. Firstly, there used to be a requirement that you had to list out all the restrictions applicable to the shares in the option grants documentation, which was a real pain and cost clients money. You don't have to do that anymore. And also there was a requirement that you had a working time declaration, which is a declaration that the employee fulfills the minimum working time requirements in order to be eligible for the EMI options, in terms of hours a week and so forth. They've taken that out too as well. So companies don't have to worry so much now about tripping up because those were requirements that were often breached accidentally. The working time requirements still apply, by the way. It's just the requirements for actually documenting the declaration have been reduced. There is still a detailed compliance and reporting regime, so there's only two things that have gone. There are umpteen things that haven't gone. But the point I really want to make here is that it may be that HMRC will forgive a minor and accidental transgression on some of this. I'm not a tax advisor, so please don't rely on that. You need to go and speak with a tax expert. But it's not really HMRC who are the problem often. In my work, which involves M&A quite frequently, we find that buyers of companies undertake an incredibly detailed review of EMI share options. And of course, EMI options are really valuable when you're selling a company, because generally the employees are cashing in as part of the sale. And they will often leap on these sort of minor issues, and most companies have them, and say, look, this is a problem, and the buyer doesn't want to take any risk here, because if you get the requirements wrong, then the main sanction is that you lose the tax privileges attaching to the options. And if that's the case, then when the company is sold, there is likely to be a tax charge, and that will be collected primarily through PAYE. So it's a company problem first and foremost before it's an employee problem. So this is why buyers run a bit scared of it. And I've seen more than once, and other people I work with have also seen regularly situations where buyers say, look, there is a tax problem here. There is a risk that HMRC will treat the options as not having their tax privileges, and there'll be a charge against the company. So we're going to withhold some of the purchase price. And that becomes a major problem. And there may be time to go to HMRC and say, look, is this okay? But there might not, and you don't want to be doing that when you're potentially going to be completing the sale in a few weeks' time, because of course you can't force HMRC to reply within your timetable. So it's an area where extreme care is still required, despite the recent deregulation. Good. That was number 2. On to number 3. I decided to put these subjects in increasing order of technicality, by the way, so apologies for number 3. It gets a bit easier on number 4. The Register of Overseas Entities. I noticed that there was an article on the BBC website this morning. I don't know if anybody saw it. It had a picture of Roman Abramovich saying that there's potentially £1 billion or more of fines coming for people who hadn't complied with this new legislation, and it was very much focused on Russia and oligarchs. Did anybody see that this morning? You can go and look it up afterwards. It's pretty easy to find. Has anybody heard of the Register of Overseas Entities regime? Yeah, one or two. This probably explains why levels of compliance have not been too great. My colleagues who work in transactions in real estate are deep in the detail of this law, but I don't think that there's a high level of awareness. It's really part of the government's ongoing efforts to create more transparency around ownership of assets. They did so a few years ago with the regime at Companies House to do with persons with significant control. So, you know, there's a name of a company, but who's behind it? That's really what it's about. So what the latest development is that last year the Economic Crime Transparency and Enforcement Act 2022, snappy title, was passed, which came into force last August, then a transitional period through till the end of January just gone. And what it says is if you're an overseas entity, that's not an individual, but a company or a trust or some other kind of legal entity, and you're not in the UK, and you are the owner of registered land in the UK, and land in the UK is all registered, or in England and Wales, and land is all registered now, then you actually have to undertake a separate registration with Companies House as an overseas entity which owns land. And as part of that registration, of course, that on its own would be meaningless because anybody can search the land registry anyway and see the entity that owns it. But as part of that registration, you have to declare who your beneficial owners are. So, you know, who's behind you. That initially caught people who wanted to undertake transactions in land, but it includes existing owners as well. Now, this is what the BBC article was saying, is there are a lot of people who are not yet in compliance, and there are some substantial fines that are going to be levied. The other twist is that it's not good enough simply to provide information about your beneficial owners, which it is in the persons with significant control regime, which existed before for companies. But it's not sufficient just to declare them. You actually have to have a UK regulated agent verify the beneficial ownership. So it's a bit like the anti-money laundering, know your customer things that you go through when you open a bank account or start work with a solicitor or an accountant. You have to do that as well, and that information has to be verified before it goes to the land registry. So it does have some teeth. There is a list of UK regulated agents. Professional firms can become agents, as can others. The lawyers and accountants are generally a bit reluctant to do this for understandable reasons, because it's incredibly high risk and rather low reward, I suspect. Although there are some that will do that. So if you have an overseas entity that you're involved with that owns UK property or is considering acquiring UK property, then you need to be very aware of these regulations. I mean, I do wonder about their purpose, I have to say, because this is all about public awareness, and I'm not sure why the public really needs to know from a purpose of combating money laundering or tax evasion. It seems to me that actually government authorities, for example HMRC, and the crime enforcement agencies, need to know. I don't know really the public needs to know. But I think the general feeling is that the more transparency, the better. But anyway, it's the regime that exists, and it's got to be complied with. My other cynicism is, if you're a serious launderer of money, you'll probably find a way not to comply with this, and you're not going to worry about sanctions because all the other things you're doing have even bigger sanctions anyway. But as I say, this is something that we're all living with, and I think we'll be living with for a long time to come. Good. On to number 4. I'm not going to apologize for this, but this isn't an update. Nothing has changed. But I'm going to cover it anyway because it's so important. You may have come across situations where a company has acquired its own shares. I'm not talking about where one shareholder transfers his or her or its shares to another. This is where a company actually purchases its own shares from a shareholder, and the shares are then cancelled or held in treasury. I won't go into that. So it reduces the amount of shares outstanding. Almost every week there's a problem with this that we come across with the client, and it's entirely avoidable, and I just want to raise awareness of it. To undertake that kind of transaction, there are very strict formalities that to be complied with, and they're not really intuitive. And it's a rare occasion where in law form counts and not substance. You have to do it by the letter, and if you don't, the transaction is void. So it never happened. So the people you thought sold their shares didn't. They're still shareholders. The money they thought they'd been paid is owed back to the company, and it's all a bit of a mess. Often that happens and nobody realizes, and everybody carries on perfectly happily, oblivious to the problem, until the company is sold. And then one of the first things that a buyer looks at is own share purchases, because it is such a difficult area. And then we'll spot pretty quickly, usually, where there are problems, and we'll say, you've got a problem here because this share sale wasn't done properly, and therefore this person is still a shareholder, but I need to buy 100% of the shares, so you better go and sort it out. And sorting it out is not too easy, and often we're in a situation where a new client comes to us wanting to sell their company, and this happens, and we're the people that need to do the sorting out. And there's not too many options. One is to just say to the buyer, look, tough, you're just going to have to live with this. We'll give you an indemnity if there's any trouble, but it just has to be as is. Some buyers will buy that, but very few will. Another possibility is to go back to the shareholders who originally sold their shares and say, terribly sorry, we didn't do it properly last time. Do you mind signing some paperwork to do it again? That is the most common remedy. It's not great, particularly if the reason their shares were bought back is they fell out with the company or the directors. That's often the case. Or maybe it was a long time ago and you can't find them. Or maybe redoing it now would actually cause some tax issues because the tax rules have changed. And also, it's possible they'll hold you to ransom because under a completely different legal regime, if you know you're about to sell the company, you can't conceal that fact from them. You have to tell them that you're undergoing a sale process, and they're probably then going to ask you how much the shares are worth. And then they may well say, well, that's all very interesting, but you've got to make it worth my while. So there's potentially some difficult discussions. Another possibility is going to court to get an order for the share cancellation, which will work in some circumstances, but it's expensive, and although it's not that time consuming as legal process goes at a court, you don't want to be doing it when you're trying to sell the company, and we've done it in parallel with selling the company, and it's not comfortable, so we'd rather it didn't happen. So just two things I want to implore everybody to do and tell your friends. Firstly, if you're contemplating a transaction where the company is buying its own shares, please get a solicitor involved who works with corporate things. And this isn't a hard sell. I don't mind who it is, as long as it's a solicitor who does corporate matters. I get the fact that often lawyers and others are saying, look, you should take legal advice on this, check this with your lawyer. And I get that often it's just not worth doing that because you'd be getting your lawyers involved in everything, and that would become expensive and you just get lost in the detail, and sometimes you just need to take a view. That's absolutely right, but not on this one. It's absolutely vital in every single case to get legal advice. I'll give you a statistic. It's a very simple one. I've come across a lot of these company share purchases, and for company share purchases that haven't been done with the close involvement and advice of a solicitor, I have seen 0 that have been done correctly. So there is 100% failure rate on these transactions where legal advice has not been involved, in my experience, which does go back quite a long way. So it is that stark, in my experience, if you don't get a solicitor involved in these transactions, it will be done wrongly and it will be found out on a company sale. And I think about 1 in 3 company sales have this issue. The other thing is, if you're working with or for a company which has historic share buybacks and you think legal advice might not have been obtained, have a look now, because those fixes are a lot easier when you're not in the heat of a transaction, and it's absolutely worth doing. It's a good investment of time, because you'll have time, you won't be distracted by the sale. It'd be an easier discussion with former shareholders, because you won't have to tell them that there's a sale for serious money about to happen, and there'll just be some other options. So yeah, thanks for giving me a 5-minute platform on that one, but hopefully that's going to help some companies somewhere. And that's me. Happy to take questions.
Thank you very much, Duncan. What I'll do now is I'll just review the questions. Before I do that, I'll stop sharing screen in a minute. So if you do want his details, just take a screenshot, take a note down, because I'm going to stop sharing the screen in a second. But don't worry if you haven't got Duncan's details, because after the event, I'll put it all out on LinkedIn. You'll be able to find him that way. So if there are any questions that potentially haven't been answered, then you can just approach him directly. So that's it in terms of the presentation. Now I'm just going to quickly have a quick look if there's any questions so far. I've got a couple of questions, I think. Right. What I shall do, in fact, if you don't mind, Anthony, do you mind if I put this on screen for Duncan to see? Would that be okay?
No, it's fine. Yeah.
Brilliant. Bear with me 1 second. I'll share this again so Duncan can see it. This is the long-winded. Tell me when to pop down, but have a read of that, and I'll read it aloud to everyone just in case. I've seen that the capital gains tax allowance does not apply to EMI schemes in subsidiaries. Is this the case if the scheme was approved when it wasn't a subsidiary, but with subsequent fundraising it becomes a subsidiary? EMI, you said working time requirements have been relaxed but remain. Could you give a bit more detail, please? Does the 25-hour remain? What has gone? Does that make sense?
Yeah, I should say I'm not a tax advisor. I have lots of people I know who are. The working time requirement, yes, the working time requirements haven't changed. It's just the documentation requirements that have changed. I'm happy to send detail on that. So it's not a substantive change. It's just one of the format and the paperwork. I think the first question was, I think what that was about was the point that you can't have a tax privilege scheme, either EMI or the other types of share incentives that are tax privileges, if there is another company that holds the majority of shares. There's an independence requirement. So if you have if one of the shareholders is another company that holds the majority, then you can't grant share options in the subsidiary company with these tax privileges. That's still very much the case. I think the question might be, well, what happens when you grant share options and then another company acquires the majority of the shares? So in other words, it happens after the event. I would need to check the detail on that, but yeah, I think it is a problem, and I think that sounds like a disqualifying event. Certainly when it's a share sale, generally the options are cashed in, but there is the possibility of rolling over the share options into options in the acquiring company. But I can see there's a less obvious way, which is the example that's been given. If there's a fundraising that results in somebody being a 51% owner, that could potentially cause problems with the share options, and that's definitely something that needs to be looked into. as part of the fundraising transaction. And if you think it might have happened without people spotting it, then that's something that would definitely need to be looked into with tax advisors or options specialists as well. I can look up the exact situation, but yeah, I'm pretty sure that the options get disqualified at that point.
Okay, brilliant. Thanks, Duncan.
Can I just check that was the question? Whoever was asking that.
Yeah. When the EMI scheme was formed and the options issued, there was that particular shareholder only owned about 13% of the shares.
Yeah.
But then with subsequent fundraisers over 5 years, they now own 61%.
Yeah. That definitely needs looking into.
Okay, thanks very much.
Brilliant. Thanks, Duncan. Risk of opening a can of worms here. Anybody else got any other questions? Hopefully if not, that's covered it. Just give you a second. Anyone else got anything else? Brilliant. Duncan, that's it. Thank you so much, Duncan Walker, partner at BDB Pitmans, for this. It's a brief overview. Look, it doesn't go into detail. I'm sure by the sounds of it, there's a lot more detail that can be gone into. So anybody needs anything a bit of a deeper dive, then by all means, get in touch with Duncan. Thank you to not just Duncan, but everybody for turning up. It's just a brief one-stop for now. Support you guys. I hope it's been useful. Thank you so much for turning up. And yeah, that's it. Wraps up today's presentation. Thank you so much, and everybody have a great day.